Nextdoor Holdings is currently trading at a price of 2.08 USD, which reflects a downward movement of 0.95% as of the market close on Friday, January 2, 2026. Since today is Sunday, January 4, 2026, and the New York Stock Exchange is closed for the weekend, this figure represents the most recent valuation before we head into Monday's opening bell. While a sub-$3 stock might look like a footnote in a market dominated by the massive swings of Nvidia stock or the high-volume movements of Tesla stock, there is a specific reason why this small-cap name is suddenly appearing on the radar of sophisticated traders and institutional desks alike. The expectation among many retail investors using an individual brokerage or a basic online investment app is that Nextdoor is a fading neighborhood bulletin board, a relic of a previous tech cycle that is struggling to find its footing. But the reality is that we are looking at a company that is fundamentally stripping away its old inefficiencies to reveal a highly valuable, verified dataset that simply cannot be found anywhere else on the internet. To understand why this 0.95% dip might be more of a tactical pause than a structural decline, you have to look at what happened in December. The stock recently witnessed a massive spike in interest, driven by reports from activist investors like Eric Jackson, who suggested that the intrinsic value of this platform could be orders of magnitude higher than where it sits today. The market expects a slow-growth social media company. The reality is a utility that owns the verified home addresses of over 100 million people. While a typical social network is plagued by bots and fake identities, Nextdoor requires a level of verification that makes its data highly attractive for local advertising. When you are looking at your Fidelity mobile app or checking your Interactive Brokers platform, you see the price at 2.08, but what you don't see in the ticker is the massive shift towards self-serve advertising. This shift is allowing the company to capture revenue from local plumbers, realtors, and small businesses with far better margins than their previous manual sales efforts. Institutional activity suggests that the big players are paying attention even if the broader market is distracted by Apple stock. Firms like Vanguard and BlackRock maintain significant positions here, and even ARK Investment Management has kept a hand in the game. This institutional backing provides a floor of sorts even when the daily volume fluctuates. For someone managing their own Schwab Intelligent portfolios or using a self-investing strategy through a Fidelity brokerage, the question is whether the current price reflects the potential for 2026 to be the year the company finally reaches adjusted EBITDA break-even. Management has been very vocal about this target, and their Q3 2025 results actually showed them hitting positive adjusted EBITDA of $4 million ahead of schedule. This is the classic tension we see in the market. The narrative is one of a struggling penny stock, but the financial data is showing a lean, mean advertising machine that is finally learning how to monetize its user base without bloating its headcount. In the world of online investing, sentiment can often lag behind operational reality. Most people opening their SoFi Invest app see the net loss figures and immediately move on to more exciting sectors. However, the reality is that Nextdoor has been aggressively cutting costs, including a major workforce reduction that saved $30 million annually. They're doing more with less, which is exactly what you want to see in a company trying to turn the corner. Their revenue per employee has actually jumped by over 20% recently. If you are using investing sites to compare NXDR against peers like Yelp or Reddit, you will notice that Nextdoor is trading at a fraction of those multiples. The market is currently pricing it as if it will never grow again, but if they can successfully integrate their new AI-powered opportunity alerts to connect neighbors with local services, they could fundamentally change their revenue profile. When you look at your Interactive Brokers account or your Robinhood investments, you might see the volatility as a risk, and it certainly is. But for those using Interactive Brokers' trading strategy, the high beta of a stock like this offers opportunities that you just don't get with more stable large-cap names. The volume on January 2 was around 3.7 million shares, which is relatively healthy for a stock at this price point. It shows that there is active liquid interest. This isn't a zombie stock that trades a few thousand shares and disappears. It is a live, breathing platform that is currently going through a massive internal makeover. They are moving away from being a place where people just complain about their neighbors toward being a high-intent local marketplace. Comment below how many shares of Nextdoor Holdings you currently hold, or if you think the company will ever be able to compete with the local search dominance of Google Maps. I want to see how many of you are actually using the platform for business, or if you just use it to keep an eye on what is happening on your street. The business model here is quite straightforward, but the execution has been the missing piece until recently. Nextdoor makes money by selling hyper-local ad placements. Because they know exactly where you live, they can show you a coupon for the pizza place 3 blocks away with a level of precision that Meta or Google sometimes lacks. Historically, they relied on large brand advertisers who didn't really care about local precision, but now about 60% of their revenue comes from their self-serve platform. This is vital because it means they don't need a massive sales team to grow. A local realtor can log in, spend $50 to show an ad to their specific zip code, and Nextdoor keeps the lion's share of that as profit. This is the smart friend take. The company is finally behaving like a software business instead of a traditional media firm. If we look back at the past performance, it's true that Nextdoor has been a disappointment for many who bought in during the 2021 hype. It has been a long road from the double digits down to the $2 range, but the market is a forward-looking mechanism. What happened in 2021 doesn't matter as much as the fact that they have $403 million in cash and zero debt. That is a massive war chest for a company with a market cap under $900 million. In many ways, the market is valuing the actual business at almost nothing once you strip out the cash on the balance sheet. This is the kind of discrepancy that value investors look for when they are scouring Fidelity mutual funds or individual brokerage listings for an edge. The technical setup for Nextdoor is also becoming interesting for those who follow price action. After the massive rally in mid-December that saw the stock touch the 3.70 mark, we have seen a healthy retracement. Buying at 2.08 is a very different proposition than buying at the peak of the hype. We are seeing the stock consolidate around its 50-day moving average, which is often a sign that the selling pressure is exhausting itself. For retail traders on the Robinhood app or using SoFi Active Investing, this consolidation period is often where the most patient money is made. You aren't chasing a green candle, you are building a position while the market is quiet. Looking toward the future, the catalysts are clear. The company is leaning heavily into partnerships, like their recent deal with Waze to provide real-time traffic alerts. This turns the app into a daily utility rather than an occasional check-in. They are also working with the USGS to provide earthquake alerts. These might seem like small features, but they drive sticky user behavior. The more often a user opens the app for a utility reason, the more ad impressions Nextdoor can sell. The expectation is users are leaving. The reality is that the company is intentionally reducing noisy notifications to improve the quality of the engagement they do have. They would rather have 20 million high-intent users than 30 million people who delete the app because it pings them too much. As we move into the first quarter of 2026, the focus will be entirely on the February earnings call. If management can prove that their path to profitability is sustainable and that their self-serve ad revenue is still growing at double digits, the 2.08 price point will likely look like a steal in hindsight. However, the risk remains that if the broader advertising market slows down due to macroeconomic pressures, a small-cap player like Nextdoor will be hit harder than the giants. This is why diversification within your Fidelity Wealth Management or your SoFi Robo-Advisor is so important. You don't bet the whole farm on a turnaround play, but you also don't ignore a company that is trading at such a significant discount to its cash-adjusted value. In the competitive landscape, everyone talks about Facebook groups or Yelp, but neither of them has the same neighborhood identity that Nextdoor has built over the last decade. It's a very difficult network effect to replicate. Even if you have the resources of a company like Apple or Google, you can't just buy the trust and the local moderator structure that Nextdoor has established in thousands of neighborhoods. This is their moat. It's a shallow moat right now, but as they add more local publishers and real-time alerts, that moat is getting deeper. For those who invest online, the ability to recognize a building moat before the rest of the market does is the key to outsized returns. To summarize the situation, Nextdoor Holdings is a company in the middle of a major transition. The market currently sees a stagnant social network that is struggling to stay above $2, but the reality is a debt-free, cash-rich utility that is rapidly improving its margins and shifting towards a more scalable ad model. The 0.95% drop on Friday to 2.08 USD is just a small ripple in a much larger story of operational discipline. Whether you are checking your Fidelity IRAs, your Robinhood cash management account, or your Interactive Brokers fees, you have to weigh the high-risk, high-reward nature of this specific stock against